Once again, billionaire investor Chamath Palihapitiya has taken a risk by making an audacious forecast regarding the financial markets. Chamath has previously adopted a daring posture in the markets. He stated in November last year that the markets had reached their top. If you were involved, this was when growth stocks and cryptocurrencies were defrauded. His reasoning was clear-cut. Elon Musk and Jeff Bezos, two of the most successful businessmen of our time, have sold their stakes in Amazon and Tesla shares, two of the main equities they had promised never to sell. If you can't take that into consideration and extract the implications, you're doing yourself a disservice. And it appears that he was right. Since November's highs, the price of Bitcoin has fallen by more than 70%. Growth stocks and the great majority of equities markets followed a similar pattern. Similarly, Chamath has chosen to forecast something else on the most recent episode of the All In podcast. My prediction now is that I think the markets are bottoming and consolidating. This is the time to start nibbling and start getting ready to rip the money in. We must admit that we were taken aback by his prediction. We seem to hear more news each day about the impending financial and geopolitical chaos. There are concerns about a possible default by Credit Suisse due to factors including currency declines in Asia and the EU against the dollar, inflation that hasn't peaked, rising rate rise predictions, leaks in the Nord Stream pipeline, etc. However, his justification appears to have some merit when we consider it. In this video, we'll look at some of the arguments against him as well as his logic. Arguments in support of a market bottoming out. 1. Rate increases are priced into the markets relatively early in the cycle. Chamath discusses why the effects of the rate hikes may already be taken into account by the markets. He gives an example of how long it took the markets to recover after a rate hike. Except for the rate hike in 1983, we can see that the markets reached their bottom just 2 months into the cycle of rate increases. In recent history, many rate increases that took months, namely those in 1987, 1994, 1999, 2004, and 2015, bottomed out in the first 3 months. In our situation, we are 9 months into our rate increases, and the markets have already factored in the profits decline and decreased projected cash flows. The odds are improving every day that we are nearing the end rather than the beginning. This is an instructive guide because this is a broad-based statement that has been true in our modern history, as stated by Chamath. 2. Irrational conduct has been coming to the surface, particularly with technology. The tech behemoths like Meta, Google, Tesla, Apple, etc. have recently implemented rigorous austerity measures. These businesses have been growing their income and earnings at an unmatched rate by other industries and had a dominant position in their respective fields. As a result, salaries for skilled workers like engineers, product managers, and business people have become excessively inflated, with outrageous incentives like free food and gym memberships. But all of that has changed now. Facebook has stopped hiring. Tesla has laid off workers. Apple is laying off contract employees. The list keeps on. When irrational behavior is exposed, the actual market value of these businesses may be shown. It is the first time in a generation, since 2003 to 2004, that we're seeing things turn the other way. We are seeing the recession hit, as stated by Friedberg in the All In podcast. Reasons to refuse to believe the market will bottom out. Chamath's forecast appears to be unpopular though. Right now, there is still far too much risk and uncertainty. A potential nuclear danger, financial horror on a worldwide scale, and default worries are added to the list. Kolanovic from JP Morgan has expressed further caution about the present picture, saying that the Nord Stream pipeline destruction substantially raises tail risks and makes it very difficult to de-escalate near term. Nuclear war is a substantial fat tail risk that is challenging to measure. Although the likelihood may be minimal, the impact is so significant that it is difficult to overlook the expected value of such a risk. Druckenmiller, another eminent investor, suggested that there may be a 10-year period of flat stock markets. He says, "There's a high probability in my mind that the market, at best, is going to be kind of flat for 10 years, sort of like this 66 to 82 time period." Despite a financial crisis in 2008, we can see from recent history that the stock market generally trended upward. Is he going to invest in the stock market? Chamath continues to stand by his claim that a hypothetical war won't severely affect the stock market. If that were true, he thinks the markets would have responded to the Nord Stream news far more intensely. The financial market does a poor job of valuing human tragedies and crimes. It excels at accounting for economic effects. Strangely, from the beginning of October, the stock market has risen and is continuing to rise. That concludes today's video. Thank you for joining us till the end, and we'll see you in the next one. Goodbye.